So Hayden, thank you for stepping in when Eli had to drop out at the last minute. Eli will be back next week for anyone that was looking forward to that conversation. He just had to close on a business. So Hayden agreed to step up and answer your questions, walk us through LOIs, all that fun stuff. You want to give a bit of background, Hayden?
Sure. So disclaimer, I am not a lawyer. Anything I say here is not actual legal advice. However, I have issued a few hundred LOIs in my life, so I can probably give some pointers. My preference would be to actually use this hour as a bit more of an office hour session where anyone here can ask a question and I answer it. So you can just use the chat to ask any question at any point. Ty, I'll just let you monitor it and chime in and ask me. I'm not going to watch it because I'll just get distracted. And so everyone has a bit of an idea on things I may be able to provide some value on. A brief background. So I started Acquira back in 2019. Before that, I had done a private equity roll-up in the digital space. So mainly software companies, e-commerce companies. We bought 15 businesses over 3 years and operated them. And in between, so we formed something called Snowball Industries, which is a roll-up of plumbing and HVAC businesses across the US. So I co-CEO'd that and handled the integration of the businesses. This was back in 2021. We put a CEO in place who's actually, I think, employee number 4 at Acquira in the end of 2021. So that was pretty fast. And, that roll-up has, since grown almost doubled. Also bought another 3 businesses. They're over 100 million revenue now. And then I came back to Acquira to kind of lead it since sort of 2022. Yeah, so I can answer any questions about any of those processes, whether it's running a roll-up, buying companies, or anything related to Acquira.
Congratulations on all your success too, brother.
Oh, thanks, Mark. Good to put a face finally. Yeah. Okay, so yeah, feel free to ask any questions. For now, I'm going to talk a bit about LOI since that was the initial topic here. Just show of hands, how many people here have a deal that they're actually looking at issuing an LOI on right now? Or maybe use the chat.
I counted about 5.
Yeah, I see about 6 maybe.
Okay.
Good. The people that have the camera on.
Okay, so I think the first question is like, when should you actually issue an LOI? And my stance on this has changed a little bit over the last couple of years. I used to do a little bit more homework before issuing an LOI, but if the deal is competitive, meaning it's a brokered deal, it's in a relatively large and desirable MSA, it's over about 700K in SDE, I think you'd want to issue your LOI pretty fast. So there are some deal killers that I'd want to get figured out first. And if your deal is sort of competitive, I would probably be okay with getting somewhat half-assed answers to them from the seller directly. So first of all, fill out the intrinsic value screening pass, right? MSA info, is the business growing or at least stable? Understanding the starting multiple, et cetera. Fill out the SBA model calculator and make sure that, the business can actually support debt. Get ideally a redacted list of employees with tenure, right? For me, that's a deal breaker. If a deal has all their employees have like 1 year tenure, that's not a business I want to buy. Get an org chart. I understand customer concentration, understand key man risk, and understand the revenue mix of the business. And that's a lot of things. And most people don't have an org chart. Most people don't necessarily have a redacted list of employees with tenure. And so I'm totally okay with asking the question on the phone, getting a ballpark answer if you want to expedite it. So asking people, hey, approximately what percentage revenue is your top customer, right? How about your second biggest? Ballpark, how much your revenue is service versus construction if you're looking at a plumbing business. If they don't have an org chart, literally build it on the fly by asking who their managers are and how many people report to them. Just build it on the call. And you can do the same thing with the employee list. Just, if they do that manager thing, ask them, when did each of them start? How many employees were hired in the last year? And who are your most tenured employees? So again, you can do that all in one call if you manage it well. And literally, you could issue an LOI after one call. You do not need a lawyer to issue an LOI. That's not me advising you not to use a lawyer. But you don't need one, and we typically don't use one anymore. We get the lawyer involved a little bit later. I'll stop there just to give people a chance to
Mark
ask
asked
any
a question.
questions.
What if the broker wants an LOI and proof of finances before sending the SIM for a casino deal from Mark Edwards?
They want an LOI before sending the SIM? That's not a good broker. You can't send an LOI before seeing a SIM.
Yeah, it was
Yeah,
just
yeah.
it's like they were asking for like 600. It was a 600 million in revenue, like 2,500 room casino deal or whatever. But they wanted to see it was just listed on a site, just on a website or whatever. And they had a whole bunch of deals in North America, South America, all over. So I was wondering about that. Like even before I even see
Yeah.
this, you want an LOI and proof of funds? Okay,
I mean, I can understand maybe proof of funds, but no way can you do an LOI.
exactly.
Okay.
Thanks.
Any other questions?
Gloria has her hand raised. Oh, sorry, Mark.
I was just going to say, how do you build a portfolio? Could you explain that later?
Yeah,
Of
sure.
businesses.
Gloria, you
Go
had a
ahead,
question?
Gloria.
Yes, I do. How do you value a business which revenues are growing in a steady way, 3 million, 5 million, and from 5 million, it lowered to jump to 7.5 million.
Mm-hmm.
But the SDA is all over the place, going from 600,000, 70, 350, 800, 400, and 2 million. It's all over the place. And of course, the broker and the seller are expecting an offer based on the last revenue and the last SDE.
Mm-hmm.
But how do you value that?
I would always value any business based on what I expect the pro forma earnings to be of that business. So I would look through the P&L. So, you talked about the revenue growing. Is the gross profit margin growing or staying steady? In some of this, is there like an increase of cost of goods? Often, you may just have a lot of OpEx increases, which you need to support that growth. And so I'd look at each of those line items and see, what is real, what is necessary. There's often a lot of add back. I also look at what they're actually calling their add backs, right? So we can talk about add backs too. That's an important topic. So, I think we've talked about this in the past, but basically owner salary should be added back to fair market. So if someone's taking out 300K and fair market's 150, they can add back 150. A lot of people will try to add back, 100% of their salary and not have a fair market replacement. You guys are technically going to take over as the new owner, and that's going to be a pro forma expense of the company. So you need to add that back 100% of the time. Even if they say they have a GM and they do nothing, you still add it back. I without looking at the exact deal, it's hard to give you specific advice outside of saying, first, if revenue is increasing, next look down the P&L and make sure your gross profit margin isn't shifting as well. And then look into the OpEx and the add backs. If a business is growing every year, that's probably one of the only situations that I'm relatively comfortable making an offer entirely off of the trailing 12 months, and opening with that. If the business has been, stable, I'd probably, or maybe has declined a little bit, I'd probably look to weight in the past 3 years, right? So with maybe a weighting at the 50% of the trailing 12 months, 30%, 2022, and 20% 2021.
Okay, thank you.
Yep.
Hayden, I got a question. So
Mhm.
I got some looking at HVAC plumbing business, already submitted IOI, and we just renegotiating kind of couple smaller deals. One question is the seller did not know exact mix of new construction versus service maintenance, but he did give me a number of high levels. He said 75% being new construction in home builds. You mentioned that as a big risk, which I do know that's a risk, although the revenue has been steadily growing year over year. Like how big of a risk is this? And is it easy to convert a lot of the revenue into the service focus, which is what I was planning to do?
Yeah, so it's a very good question. So I would say everything here is very nuanced. So not all construction is the same. Not all service is the same. So when you say residential construction, custom homes to me is quite different than stock homes, right? So, like track homes, basically the question is like, what's the price per square foot that the builder's charging in these homes, right? Because effectively, any builder will allocate a percentage of, their dollar per square foot to a sub, right? So if it's a plumbing sub, do you say plumbing or HVAC?
Both.
Both? Okay. So it'll be like, let's say just under 2% to a plumbing sub. If that builder is, charging 400 a square foot or 500 a square foot, your gross margins on that are going to be in the 30% range, 30 to 35, maybe even 40% range. If they're charging, 200 a square foot for some kind of track home and doing it in volume, your gross margin is going to be, you're lucky if it's 10, right? So that's the first thing I would say is not all construction is the same. If they don't know their full numbers, and that's not uncommon, that's not like a killer to me. But look at their actual headcount, right? How many service techs do they have, and how many construction guys? Oh, they have 11 service techs. Okay, then yeah, that's healthy. Do they have service leadership? Do they have a service manager?
There's one guy, I would say yes, somewhat.
Okay.
I don't know if they call it necessarily that way, but yes.
Okay.
Yeah.
So Snowball's entire thesis was buy construction companies with a service component and build out the service division. And I can talk a bit about that. And we did it very successfully. And other people who within Acquira have done it quite successfully. Just because service is more recession resilient, it's predictable. It's basically got negative working capital. It's just a better business.
Right. And one more thing, we're negotiating a big seller financing portion of this. Right now, we potentially will be able to do 70% seller financing over 10 years. Is any risks associated with that, like that I'm not thinking through? They
risk for you?
Well,
I
they want to have,
Yeah.
of course, first position, right? With which is, I assume that's normal.
Yeah.
Yeah. But that's about it.
As long as there's not, is there any kind of retention of equity?
No.
No. What's your deal with the transition period? I mean, 70% seller financing, I assume they want to help as much as they can.
Yeah, so 1 year, 6 months full time, and then going to part time.
Okay. No, I mean, congratulations. That's great.
Okay, well, it's not done deal yet. Yeah.
Have you locked in on an interest rate?
Yes, basically
Okay.
0, but that still needs to be confirmed.
Okay. Wow. Yeah. One tip for anyone else who's not there yet. I always put the interest rate at the applicable federal rate in the LOI, and I very, very rarely get anyone push back on it. which, depending on the term, is either mid or long term. It's around 4%. And if you put your interest rate at 4%, everyone's going to, come back at you and say, no, I want, at least prime. But AFR seems to work really well.
Okay.
Yeah.
Awesome. Thank you.
Did you want to go next? Go ahead.
No, go for it.
Alec, you had your hand up.
Nope, that answers my question. You guys can't hear me.
Oh.
Thank you guys. So I have investment thesis, or I have investment committee Tuesday, kind of second round for the same business. Had to go back, get another round of information, particularly financials, because it's an off-market deal. It's a data aggregator, government services. It's actually like a sub pillar of my investment thesis, but it's a good base because it's manufacturing aerospace. That's where I'm bullish on it right now. The reason I'm asking though is because I have a CPA, I don't have a broker. He doesn't have a broker because it's an off-market deal. It's an old vendor. When it comes to, you had just hit the nail on the head with, you don't necessarily need an attorney. That's the juncture I'm at right now. Is I was going to start diving into attorneys to write up the LOI. Since you're saying that's not necessarily where I need to go, advisory in that capacity, how can I spin one up pretty quick? Because I want to mitigate seller fatigue, because we have been going back and forth. He didn't have everything. He wasn't ready to sell. He wasn't going to the market, right? So advice on that.
Okay, so specifically how to mitigate seller fatigue and when should you involve an attorney? Okay.
Being able to quickly spin up an LOI without having to use an attorney necessarily,
Okay.
or should I, because of my circumstance, just use an attorney from the jump?
I would at the very least get someone to review your LOI before using an attorney. So somebody like Rich, right, or somebody at Acquira can definitely review it. In an off-market scenario, if they're not sure about their counsel, I highly recommend using a neutral closing counsel. It's way cheaper, it's way faster, and you don't have a broker telling you. I mean, so I've had brokers recommend it in the past, but you don't have a broker telling someone not to use that, and you'll avoid the problem of the seller getting their divorce attorney to represent them.
Yeah.
So now each party may still have their own attorney, but basically you have these templated neutral agreements that the neutral closing counsel basically says, here are the agreements, here's something that's, buy side favored, here's something that's sell side favored, here's something that's neutral, and you can just, run through it super fast. I know Daniel used one, they charged $5K, $2,500 on both sides, and then he never even used his own counsel. So if possible, I'd look into that. There, I know Brian is working with a guy named Wayne Zell who does some seller, advisory support. So he's not a broker, but he helps with tax planning, estate planning, and he's become a friend of Acquira. So if you want to reach out to him, I think Zell Law, Z-E-L-L Law is his website. That's an interesting option that we're using now for off market, because we found exactly like that. Like, it's good to have someone who's counsel who also but doesn't necessarily have any competing conflict, which brokers often do.
Absolutely. Yeah.
Does that answer your questions?
It does. And just because I was trying to, because I know the seller so well at this point, we have over a year of rapport, because really we had a working relationship and now I have this acquisition relationship. I just didn't want to have any seller fatigue, and I wanted to be able to give him a couple of different options, really kind of within the same scope though, like give him 3 options. Hey, this is where we're at. And I wanted to be able to punch it out shortly after the IC Tuesday, at least post advisory, make sure we have dotted our T's and I's and all that jazz. So that's where I'm at right now with it.
Great. Good luck.
So Ryan asked about Rainmaker Advantage plans. Is anyone at Acquire familiar with this exit strategy, and is anyone that you're aware of used this service or structure offered by Benetrends?
Oh, is this the alternative to
Larry
Rob's?
Carr.
The
Yeah,
wrap?
Yeah.
there was a guest on one of Rich's calls
Yeah.
a little over a year ago, and seemed fairly compelling from a Track's favorable exit. But I'm curious if anyone at Acquire has actually engaged with them, if there was any feedback or lessons learned.
I've not engaged with them, so I can't give advice on this. I do know Chris has spoken with them. Chris Mooney, who runs Acquire Capital, has spoken with them at length. I would reach out to him to ask. I mean the feedback I heard, but I don't know, again, I've never worked with them directly. The feedback I've heard is that it seemed like they played in a lot of gray areas.
Okay.
Yeah.
Okay, good to know.
This is the whole wraps thing, right?
Yeah. So it looks like they've got ROBs and wraps, and this
Yeah.
is wraps, I guess, where you basically have two classes of stock and a C corp. Part of it is held by a retirement plan. Part of it is held by the business owner, and most of the capital appreciation of the business lands in a Roth. So once you've reached retirement age, you've essentially exit tax free. Not an attorney, not a tax attorney, and curious kind of where things are gray, where things are black and white. And just because it's gray doesn't necessarily mean it's bad, but I know if we got a pretty big network here, if anyone is actually engaged with this gentleman that was on a call, I don't know, 12, 15 months ago.
Yeah, if anyone else has, be great to hear from you.
Yeah. Meanwhile, Casey asked, thanks for the question. If the owner takes drawbacks or draws and does not have any salary, do you add that back? It is on the balance sheet, but not in P&Ls. It seems like they would be falsely representing money that is not actually there.
If they don't take salary, but they take a draw, I would still add back the fair market salary for that position. Which is, I would say, probably a minimum of 100,000 and a maximum of 150,000 in most of the business sizes we see.
He also asked about multipliers and how do multipliers change with businesses around the 500K SDE range?
Like SDE multiples?
Yeah.
Yeah, closer to 2x.
Does it matter like if it's 490, 515? It's like
No,
it's around 2x.
Yeah, it's closer to 2x. It'll depend on the industry too.
Okay.
Tomas, you had a question?
Yes. Yes. Hi, Hayden. Great conversation, by the way. So my question is, I just finished the courses at the beginning of the year and started looking at businesses just recently. And I'm looking at the industries that Acquire is talking about. And as I reach out to brokers, I get a lot of, not pushback, maybe that's a little strong, but a lot of them are saying that the owner is looking for somebody who has background in that particular industry in many cases. And I'm wondering, one, what should I tell them? And two, are we really equipped to run, for example, an HVAC business that I don't have much experience with? I guess it has to be big enough to, it has to have a team big enough that the owner can focus on the non-technical aspects of the business. But like, how much do we really need to understand the technical aspects of the business?
Yeah, I personally, I mean, it's up to each individual. I personally don't know anything about actual plumbing or technical HVAC work, but I've run multiple businesses. Now, if you're looking at businesses where the owner's doing technical work, that's another thing I'd add to don't buy that business, because it's basically expected that someone needs to replace that knowledge. I would lean on your personal background, anything involving leadership or business or finance or, any of these things that are appropriate to running any business, whether it's, plumbing or, building rockets. You can lean on the Acquira background, that you work with a group that has bought several home service businesses. That often helps. Probably there are people in this call who can give you better advice than me too, because they've gone directly through this.
Okay.
And sorry, is that it? Does that answer your question, Tomas?
Yeah, it does.
Great. Gloria asked, what is the maximum percentage for seller financing allowed by SBA?
There's no maximum.
Anyone else have a question?
I think Alec has
Alec.
his hand up.
Mhm.
I'll keep pinging this if you want to. So
Go for it. Huh?
maybe for a kind of a different vein, when it comes to structuring some of the options, I have a particular seller who isn't looking as much at seller financing, but seems a little bit more open to creative if I can give him a multiple or at least sustain some of his current cash flow that he's taking in. And at that juncture, the CPA had brought up, and I wasn't too hot about it initially, but I'd love to get kind of the group's consensus on maybe leveraging annuities or whole life policies to substitute that for at least a period after a 2-year standby, or maybe even instead of in lieu of a 2-year standby. Any advice in that regard, with knowing what the desired end state of the seller is to keep some sort of cash flow?
What amount of cash flow in relation to the current cash flow the business is providing the owner?
Less than probably about 30%-ish, I would say. So
Are you looking to use SBA?
it depends on, like, that's exactly what I'm looking at and
Yeah.
trying to chop up the 3 different options. That's all up in the air for me.
Yeah, I mean, the main question, the first question is whether you want to use SBA. And depending on and there's a lot of questions there, like how much seller financing, or, how creative, because you have this long-term relationship with the seller, how creative can the seller be? Most, banks will not do goodwill cash flow lending for businesses around the size that we're looking at. That typically starts at 2 to 3 million in earnings. So that's your first question, because if SBA is included, a lot of other things are excluded, probably including some of the things that you mentioned, and you'd want to talk to someone like Alan specifically to say, hey, if we're using SBA, is this allowed? And then if you're using SBA, typically your only creativity will come in the form of seller financing. Now, seller financing can do what you're asking, what you're looking to do. You can have, forgivable notes that effectively act like, earnouts. So there is a little bit of flexibility there. The thing I typically, the one piece of structure I will typically advise against would be actual retention of equity. Just because in all my experiences, it's difficult to have 2 chefs in the kitchen, so to speak.
Yep. And that's not a concern. He had even put on the table, he's a majority owner, but has 6 other stakeholders who, some of which are, it's like employee kickbacks in the form of equity and the dividends, right? But he wanted to he was willing to give 100% of that. Probably for some of the key elements there, I would let them keep pieces of that or do some sort of equivalent value when it comes to dividends, at least as a motivator for them on the team. Otherwise, equity is not a problem with him wanting to retain it. His cash flow, he's aging, he's like 78 years old. He's not looking for like a 10-year balloon, right? Like, he doesn't want to wait to the end of his life to get paid on it. So that's why he's like, hey, like soup to nuts. He's like, can you give me my current cash flow or multiple on it or a big check. And I'd much rather not do SBA if I don't have to, just because of the rapport basis I have with him and the leverage that it's an off-market deal. He can't necessarily sell it, but it's a great base for what I'm looking for, roll-up side of the house. So that's kind of the lever point, if that makes sense.
Yeah, so if you're not using SBA, earnouts can be used here. You can still use a majority seller financing option, and that would give the seller. It sounds like that would probably give the seller what they need. I mean, you'd have to run the math here. I don't.
Yeah.
Okay.
Okay, perfect. That's all I wanted to hear. So just kind of bend your ear in that regard. I don't know if anybody else has a supplement to that or anything like that from their experience or doing some of their own deals.
Alec,
James, you got a question?
we in a
Sorry.
similar position. You can DM me if you want to talk through that, because my seller was also concerned primarily about cash flow, and which is why we structured in very high seller financing.
James, what was your question?
So my question, it's related to the earnout, the SBA eligible earnout. So I have been going back and forth with the seller 2 months now, right? So I finally got him the revised LOI. We have been speaking in terms of a contingent seller note, right? That is kind of going to be tied to top line revenue for ease of tracking, right? So he's not scrutinizing expenses or what have you, right? So then he gets the LOI, which kind of details a revenue test, right? And it's almost like he's surprised, right? So when my lawyer, I did have a lawyer draft it, right? Confirm my speaking language, Arabic. Nice. I guess I'm speaking Arabic. Sorry, this is Zoom popping up all over my screen. So my lawyer initially drafted it saying that there would be a 12-month test, right? And then a sliding scale of, if it's within 5%, then it's 25% forgiveness. If it's within 10%, it's 50, 75. And then if it's over 20, it's 100% forgiven, right? And then it would be paid out over, so that forgiveness amount would be kind of amortized over whatever the term that we agreed on, right? It would just continue, the payments would change. I had him redo it and basically switch it to, because this note it's a $3 million note, right? And it's amortized over 15 years. And then I had him change it to quarterly checks, right? So the payments would be quarterly, and then it would be based on the trailing 12 months from close, and then in 3 months, check trailing 12 months versus our close. And if it's, more than 10%, then it's forgiven, right? And then, so I guess I'm not sure how this is normally done. So my lawyer was like, this is how he's done it. That didn't really seem fair to me. I didn't think that was as good of a deal for the seller. I didn't think it would be as attractive. I thought mine was better, but then it comes to a 7-year balloon, and he's like, oh, so at the 7-year balloon, $2.5 million or $2 million just can go poof or whatever. But I don't know what's normal, right? So I don't know if there even is normal in this space, especially when it comes to SBA and eligible earnout, right?
I think normal is quite bespoke. And so I think if you asked, 5 lawyers about what they'd recommend, you might get 5 different answers. I personally, okay, so the seller is your most important relationship, not only right now, but also post-close. So I wouldn't do a deal that feels like they might get screwed, right? So I would start there. I've seen tying this to DSCR, right, as another alternative. And then are you having multiple notes or a single note? Have you talked to anyone at the SBA about this?
So it's two notes. One's a full standby note, and the other one is
Yeah.
a contingent
Okay.
note.
Yeah. Okay. Yeah, it's probably above board. I would, again, I would direct you to Chris on this side. I know he's done some very creative things. But yeah, as long as you have the two notes, I imagine it's above board by the SBA. And in terms of what standard, you know, there isn't a standard.
Sure.
But I would favor the fact that this is an important relationship, and so
Try to make
do
him as
something that-
happy as possible. Yeah. And I kind of went back and where it's like, we're not even maxing out SBA, right? And it's like, I think he's more worried about the potential of, and I don't know, you know what I mean? It's a dance. So it's like, he's like, well, I don't even know what the business is going to be like in 7 years. I'm like, well, I don't either. Right. I'm like, and I imagine before 7 years, we're going to find out. Right. We're not going to get to 7 years and be like, oh, surprise. You know, I was like, by year seven, I'll probably have already paid you off, right? Entirely. I would hope. But okay. So there's no standard. That was really my question. If there was like some sort of a normal, you know, is the 12-month checkpoint, is that more normal, right? And then it's just kind of adjusted from there. Or if it, you know, I felt like the stretching it out was more favorable, but then he's just like, he's never seen it before. The broker's never seen it. They don't know how to react to it. They're like, well, what do you mean forgiven? Do you mean it goes to the end of the note? And it gets tried to, you know, what if he's down 5% this payment and then he's up 10% the next one? Like, does he get double payments? And I'm like, well, that for sure, no, right? I know that's 100% not eligible because the seller can't benefit. It has to be a benefit to the, or a rebate to the buyer, right? It can't be a benefit to the seller. But okay, no, that answers my question. I appreciate it.
Any other questions? Step right up.
Okay, if no other questions, I'll continue talking about LOIs.
Actually, I do have one more question. It's actually not related to buying a business. It's actually related to Acquira. And since you're the founder, right, buck stops with you, I guess. So, so Acquira's changed a lot, right? So I've been with Acquira for a year, right? And there's been churn, right? Normal. So there's been like people coming, going, moving up, down, sideways. What does that look like now? I know we had a call with Brian, because Brian was originally the one guy. He was the ace, the integrator, right? Essentially. Now he's the president, and he kind of gave us a high level of the vision, right? And how you guys are kind of changing to a co-op type model. I think he said not a co-op. What did he say? It was like a ESOP type. Yeah, ESOP. And that you guys were also looking to change like from away from the Accelerator Plus to a more you guys kind of find the deals where you can find them, and then once you have a deal, you kind of find an AE that's in that area and be like, hey, we have this deal. And then moving towards a transaction advisory model where it's like, okay, once you sign the LOI, then you sign this. So maybe could you comment on that? Or
sure,
do you have any
overall?
Yeah, so like all the changes that have kind of happened and like what it looks like now and when we can expect something like that, I guess, to actually happen.
So Acquire was like an experiment when we launched it, right? And it took you know, a full rotation of the flywheel takes like a year or longer. What we found was probably about 15 to 20% of about 15% of people who enter the program buy a business. And we kind of looked at where the drop-off points were, and a lot of people just didn't get to that LOI piece. But and that's why we created the Accelerator Plus, was basically let's get it so that, you know, as close to 100% as possible, at least get an LOI out, right? And then our stats from there are like 70% LOIs close. In terms of like what we're doing, so I mentioned I did Snowball. I did Snowball. It was a bit of an arranged marriage when we did it. And the reason I kind of left earlier and sort of we sat in more of a board seat was that there was a bit of a culture misalignment. You know, we're really employee centric, and our partners were a little bit more private equity based, I guess. And so, but that to me was very inspirational, because I love scale, and whenever I do something once, I want to figure out how can I do this 1,000 times. That's just how I'm wired for some reason, and that's why Acquira exists. And so I wanted to know, how can I do more snowballs, and how can I do it in a way that aligns with the culture I want to create, which is, you know, more employee centric. And then how can I do it with partners who I know share the same kind of values? And so that's kind of what led to this instance, or this current iteration of Acquira, which, you know, yes, we're helping people buy their first business, but to me, it's more of a, you know, the midterm goal is really, it's an ecosystem to identify, you know, talent and partners. And so we're doing our first consolidation of successful AEs this year, in their businesses, and they're basically going to run their own snowballs, their own platforms. So that's where we're kind of going, is, you know, if you guys buy a business and successfully integrate it, and you know, we work with you for a year or two, and we see there's good values fit, you know, there's a way we can work together to help you build out a platform, right? So that's kind of the midterm goal. And then the goal behind the platform is a bit of a reshaping of private equity, in that we want to form an ESOP, and basically contribute the company to the employees, which is effectively, you know, a very long-term liquidity strategy. Basically, you contribute to the ESOP, that's a tax deduction. The ESOP buys shares from you at whatever the current value is. That value goes up because you're buying lots more companies.
Are you talking about ESOP for Acquira, or ESOP related to the companies that you're buying?
ESOP related to the companies that we're buying.
Okay.
Yeah. Yeah. So yeah, Acquira is kind of like this, I guess, the service arm to make that happen. Kind of key to that. Is that helpful, James?
Yeah, so it's, the idea is, one, I mean, I'm not even too familiar with an ESOP. The most I know of an ESOP is like, there's a grocery store here, Publix, which is technically an ESOP, a very, very large one, right? And I
The
guess I
largest,
just mean
yeah.
it's like owned by the employees only, and it's not like on the public market, essentially, right? How does that, I'm not too familiar how, so the goal is for Acquira to kind of be the Publix of small business, but then all the small, like, is it one giant ecosystem of, you know, Acquira owns all these, or I guess it's not owned by Acquira, but it's like Acquira's the group, and you can sell to Acquira to become an ESOP, and then you get shares in that. I guess I don't really, you know, understand the logistics of it, or how is that more
Yeah.
attractive than the alternative of what, you know, owning it yourself? And is it just because it's something, you're a part of something much larger, less risk?
Yeah, so I mean, the scope of all that is probably outside of 14 minutes, but
Yeah.
I basically, ESOPs are a liquidity strategy. They have a lot of tax advantages. They're one of the few things that have had bipartisan support for like the last 40 years, because they kind of have this generational wealth creation mechanic for the right, and then a redistribution of wealth mechanic for the left. What effectively happens is that the government is effectively paying for the shares, right? And so you're effectively selling shares to employees, but the employees aren't paying dollars out of their pocket. So eventually, over many, many years, if you're not using a leveraged ESOP, if you're just doing this every year or every other year, you're slowly getting liquidity, right? So it is a liquidity strategy. Now, if you're using a leveraged ESOP, you know, the easiest way to think about a leveraged ESOP, there are other tax advantages as well, is that, you know, if you're selling your business to private equity, right? Private equity is typically going to, you know, ask for, let's say, a 30% earnout, put in maybe 10 to 20% equity, and get the rest in debt. In a leveraged ESOP, you're effectively going to do something like a, you know, 30 to 40% seller note, and then you're going to take the rest out in debt from a bank anyway, right? And so it's the same thing, and there are different tax advantages. Your other question is, why would someone do this? I guess, like, what's the motivation? The motivation for most people who want to do it is that they want to be they want a smaller piece in a bigger pie and have the experience of building something big, as opposed to like when I send the offer out, it's like, this is what we did with Snowball. You could probably do it on your own. But with the lessons that we've learned and working together, I think we can build something 30, 40 times bigger. You also get rid of the SBA loan and cash out a bunch of money. So that's the nice thing. So I think most of the right partner wants to do it because they want to kind of get to that, I guess, get through the next ceiling of entrepreneurship, if you will.
So and I guess just to clarify, and I don't want to take up too much time because Tomas has a question too, but so again, I wasn't too educated on it. I probably should have, but I didn't think about it until you hopped on. So the idea is kind of similar to like a strategic buyout almost, where a much larger company buys a smaller company and then they get shares in the much larger entity. Kind of that, is that the same idea? So you get paid out, but then you also get shares.
Correct.
You also get, like some equity in the bigger thing that is.
Right. There's a rollover portion. Yeah.
Okay.
Yeah.
And what is the rollover? What is your guys' idea there? I don't know. Is it like is it varying depending on how big you are and how, great your business is?
I mean, with the first cohort, we're doing a 20% rollover, 80% cash on the sale. Now that will probably change in future cohorts.
Cool.
Yeah.
Okay. That makes more sense. Thanks.
Tomas, I see your hand, but I'm going to let Kelly's question get in. Can you talk quickly about first year additional costs like ACE, GM, and replacement salary? And then we'll get to Tomas.
Yeah, so replacement salary, I would say pay yourself fair market. And you can research what fair market is. Like I said, typically it's like 100 to 150, depending on where you are. It might be higher in certain high cost of living locations. ACE costs 100K. Typically that's 50K up front and then 50K sort of towards the end. Typically we suggest you finance that into either the SBA loan or into like a side line of credit. You should think about working capital as well. Like that's a big consideration. And you probably want to have at least, I would say, 2 sources of like a working capital line of credit. Typically the SBA will offer you one. Your local bank might offer you another. Amex is another option. And actually working with the seller on a line of credit is another option.
What about sort of percentage of working capital, like 5% of revenue? Is there some sort of KPI or?
The conservative might be 3 months OPEX.
Okay.
It's gonna depend on the business. Going to depend on the type of business. A construction business has far higher working capital requirements than a service business, as an example. I'd say for construction companies, the QOE will come at a few different options on working capital. I would say for construction companies, budget even higher than what the QE comes back to you with. And for service companies, probably budget lower.
Thank you.
And then for GM, I'd say don't hire a GM in the first year. Don't have that as part of your plan, even though it might happen. Also, the SBA will not like that if it's in your model.
Yeah, skin in the game and all.
Yeah.
Tomas, what was your question? Thanks, Kelly.
Yeah, it's also related to financing. So I'm happy that we went back to that topic. So the question is, what would be like a healthy capital stack for an acquisition? I guess, of course, it depends on how much capital I am able to put in, but I feel that like doing a 70 or 80% LTV SBA loan just feels like something that doesn't allow me to sleep very well, no matter how good the business is. So like how should I look at it, or how should I budget for it?
I agree with you. I would say that it is an individual preference and, risk tolerance amount. I've been thinking a lot about like working capital anxiety. Like there's every different individual has like a different anxiety level. And I think it's the same here. I personally optimize for a DSCR. So I look at DSCR first, and I want the DSCR to typically be 2 or higher. I also look at post-debt cash flow. And so I'd say for like post-debt cash flow, when I say post-debt, I mean pro forma post-debt, not necessarily taking into account like year 1 growth considerations, right? But just what does the business today look like, kind of pro forma, right? Not me putting in an extra 200K in marketing expenses because I want to test something out. I would like to see for a service business that to be at least 350K a year, and for a construction business that to be at least 450K a year. I think that's in the training. It's higher for construction because construction has, you have more risk to lose money by. And I agree with you. I personally think, and this is what we do. I didn't answer your question, James, on the seller funnel side, but this is what we do on the seller funnel side. Is I like to have at least a 20% seller note that's at a minimum has interest-only payments for the first 2 years. Because the reality is that all the risk, well, not all the risk, the vast majority of the risks happens in the first 2 years, because that's the change management, and that's also where you as the owner, you don't understand the business, and you're learning, you're getting the subject matter expertise, right? Every business has some level of turnaround that you don't expect, right? So you need to accommodate that both mentally and financially, and that always happens in the first 2 years. So protect the cash flow the first 2 years and use seller notes to do that. Is that helpful?
Yeah, it's helpful. I have another part of this question that's a very technical one. So I have an investor who's overseas, and I understand that if he would have an over 20% equity position, he would be personally guaranteeing the SBA loan, which he's not going to do, and it wouldn't make much sense. So how does the SBA look at overseas investors with a larger than 20% equity stake?
Well, they can't have the personal guarantee if they're not American. First of all, the way around, and this is what we figured out with Acquira Capital, the way around all of these things is it's typically about control. And so I would first talk to someone like Alan, and confirm that if this person has, let's say, 25% of the common shares, are they able to do that? There's not going to be a personal guarantee because they're not in the US. And if he says no, the way around that is to structure this such that your investor gets preferred shares and you get common shares, and that and that you have, let's say, 100% of the common shares, they have 100% of the preferred shares. That gives them a certain level of the economics of the deal. But it doesn't give them control over the deal, because there's basically 2 types of lenders. One that looks at who controls, and the other who looks at who gets economic benefit. And so Alan from First Internet Bank really looks at who controls. And so that's why with Acquira Capital and stuff, he's got no issue. And that's the way Acquira Capital is structured.
I see. Okay. Yeah, that's very helpful, because that was one thing that I was thinking about, like how can we make that work? Can I not discourage him to invest by telling him that, hey, there's a personal guarantee that you might need to put up? Anyway.
The thing you'll need to protect in that instance is there, typically within the employment agreement that you'll have, they would need to be protected with some minority interest, some minority rights, right? So, for example, you can't put personal expenses through the company or pay yourself more than fair market value or hire all your family.
Understood. Okay, thank you. Very helpful.
Yeah,
I
you're welcome.
have one more question. I know we're coming up on time. And this is related to somebody else who's in Acquira, and they kind of brought a deal to me, and it got me thinking as well. Where it was similar to the very first question. It was it's an electrical business, right? But they've got like 60% on one customer, right? And this one customer is a builder, right? And it's kind of like a track builder. I don't think it's a custom home builder, so it's probably on the lower end of the spectrum, right? But again, it's 60% of revenue, but that doesn't necessarily mean it's not going to be 60% of profit. The other spectrum, the other end of that is service, right? So when you would look at something like that, how would you weigh that? Would you, obviously that's a lot for customer concentration, right? So he's trying to mitigate that with like a seller note, but would you look at that as an opportunity to kind of like take those people and just transition it to service, right? Like the higher margin, because you'll have more employees, right? And then you just kind of sunset this lower profit activity, or would you look at like trying to maintain that and, because it's more worried about like, well, what if they go away, immediately and et cetera, et cetera.
So I'll tell a story about a company that Snowball bought. That had very high customer concentration, exactly this scenario. Basically, they were an HVAC builder, and this one customer, they did all their A work, their B work, and their C work. And after we bought the business, we kind of did created a segmented P&L, right? And looked at each builder, and then each was separated construction by segment, track homes versus two-story versus custom. And we found that the average gross profit on their track homes would represent it, I believe, almost 45% of the revenue, just the track homes, was like 2%. And there were a lot of jobs where it was negative. And so that was an opportunity to raise prices, which, with the leadership team, we're very hesitant to do, because the culture of the company was to take care of this customer, right? But, when you pointed out, well, realistically, if we lose the customer, we can just spend the time training the guys, right? And we basically are not making any less money. So yeah, long story short, we ended up increasing the price 50% for that customer, and then 50% again, and they didn't balk. Neither time.
Okay.
There in the screening pass, which is really meant to be a screening pass, meant to be a 5-minute pass. There's a customer concentration where you're looking at revenue. There's another course called Intrinsic Value Second Pass, which is your post LOI pass. That pass looks at it by gross profit, and it also looks at it by referral, not just economic user. And so I really encourage people to do that, because you may find that 60% of revenue represents 15% of gross profit, and now suddenly you care a little bit less, right?
Right. And that's what I assume too, right? Because just by nature, it's going to be lower margin, right? Being a lower budget track home, right? And if he's already doing the service, and then obviously the hardest part of growth, I would think, is hiring, right? And getting the people, right? And if you have the people that you can then cross train, like you said. So, okay, no, that's definitely helpful. So I'll pass that to him too.
Because I realized every single business we bought basically we discovered this. There was some segment of revenue that was, not very profitable. We actually got our QE providers to start doing this as part of the QE. And there was a business, Daniel's business. I was integrating it, and the QE came back, and we found out that their residential construction department, basically, which had like 13 people working for it, was making less money than their 3-person service department in terms of gross profit dollars. And I kind of casually asked like the GM, it's like, hey, if I told you this was the case, what would you think? And he's like, I think you would have to check your numbers. And it turned out to be the case. And operationally, you could see literally day one of the on-site, you could see exactly why it happened, but it's not uncommon.
And I guess piggyback one last, sorry, and I know we're over the buzzer. So when you see growth for these businesses, right? So as I was speaking for like a home service business specifically, and I kind of spoke that I would think the bottleneck is hiring and having like the bandwidth. So do you see like the opportunity of getting more business through like digital marketing and getting the leads? Like, is that the easy part? And the hard part is like getting the people to get there? Or, you know, is there almost like an infinite number of customers that you could theoretically get if you had the trucks and the people in a larger enough market, right?
So yeah, in terms of like serviceable area, technically, if you're good at digital marketing and you're good at operations, because techs can take their trucks home with them, and because you can have multiple listings, you know, strategically, one for a warehouse, one for a marketing department, one for your actual office, right? One for a refueling station, right? The serviceable market is the cumulative, basically 1 hour driving distance of where your techs live, right? Which means it could be like easily a 300-mile radius, right? So yes, your addressable market grows a lot. The bottleneck will depend, right? It's always between managing demand and supply, right? You want to work on, like, if you're building a forecast, like the unit economic you're starting with is demand, right? You typically want to keep your techs busy, right? And you want to make it a good place to work where they're making good money. And so that means you probably don't want to make hires until there is a little bit of until availability is actually becoming an issue, right? So you're at least, 4 or 5 days out when people call. So you start with demand. How difficult supply is entirely based on your company culture, and your company culture is this. I've heard it described many times by people as a word on the street, and it is nothing to do with reviews. If you want to do diligence on this, I would suggest go to your supply houses, your vendors, and ask them what are the good companies to work at. And if your target company comes up, great. But I've had companies where people just line up and walk in and constantly and give you resumes. And I've had companies where you're, mining Indeed for hours every day and nobody wants to work there. And it comes down to the local reputation, because what you're buying here is, typically it's like a 40-year reputation, right?
Yeah, that's super helpful. That makes a lot of sense too. And I didn't even think about that aspect, like the supply house, because you could even use that as a way to look for leads, even, if you wanted to.
Oh, yeah.
That's a really good idea.
It's the water cooler.
Yeah. All right. I appreciate it.
Hayden, are you pressed for time? And can you take one more question from Mark?
Yeah, I'll take one more.
Thanks, brother. Quick question. At what point in time when we're building a business portfolio, do we file for Regulation D forms with the SEC?
Do you file for what?
Regulation D forms with the SEC.
Reg D forms?
Yeah.
I mean, that depends on, I mean, that's for raising capital.
Right.
Again, I'm going to use my not a lawyer line here. But basically, I'll tell you what to ask people. Okay. If you're raising. So typically it's 506C or 506B, and that's based on whether, I mean, the main difference there is how you can market and who needs to accredit the investors. So, and you can Google that stuff. There's lots of info about that. Basically 506B, you can't really market directly. You can have one-on-one conversations. 506C, you can. So Acquire Capital is a 506C fund. And then the question is, are you operating the company, or is it basically investing in securities? And in small businesses can be considered securities. And then there's a whole investment company act that you need to look into. And there are certain exemptions to investment companies, such as like 3C1 and 3C7, I think. And so look into those things as well. Talk to a lawyer. I'm not a lawyer. This is not legal advice.
Thanks, brother. Appreciate it.
Yeah. No limit to funds raised, by the way. If you're doing a GPLP structure, there are some limits. if you have the 3C1 exemption, you have a 100 investor limit before you're considered an investment company, and then there's huge requirements there that you don't want to go through. So then that changes your minimums, right? If you have 100 investors and your minimum's 10K, you're not going to get much money.
All right.
Cool.
Hayden, thanks a lot for stepping up today.
Yeah, my pleasure. Thanks
And
everyone.
for everyone, this
for your
recording will be
questions.
available in like a week.
Thank you.
So to Lay's question, sorry. So Lay's question, does Acquira handle, do you guys have your own agency that you guys use or recommend? So I've heard that you guys kind of have an agency that if you work with like Ace, then you kind of just by default work with.
By agency, do you mean like digital marketing?
Yeah, digital
Or-
marketing. Yeah, exactly.
Yeah,
Website.
there's a
et cetera.
company we recommend. We don't own them or have any.
Okay.
Called Matyx, Matyx. They actually do our marketing and they do our buyer funnel and our seller funnel. And to answer your earlier question, we now have that seller funnel live, and it kind of duplicates the buyer funnel, having calls with sellers, paid ads.
Mhm.
Yeah, so Matyx, guy named Tucker. Tucker's been sort of contributing on the Acquira side as well, but we don't own his company.
Matyx.com.
Yeah.
Cool. All right, I appreciate it. Thank you.
I love
Good
to
meeting you,
talk
by
to
the
you
way.
about the video game structure, why you guys got out of online gaming, but we can do that like in a DM or something on Slack.
All right, cool. Thanks everyone.
See you guys.
Thanks, everyone.
Have a good weekend.
See you guys next week.